Hello and welcome to our third web chat in our hedging series on how negative rates can jeopardize your interest rate hedge program. We are joined by Ruth Hardie, Senior Director, Client Services at Hedge Trackers, who has been at Hedge Trackers actually since the inception in 2000. They have had their 20-year anniversary this year and currently manages the interest rate derivatives accounts. And she's done loads of different work inside Hedge Trackers. Now, you're going to be talking about 4 factors in our interest rate hedging and accounting. Can you explain? Can you tell me what you're going to do here?
Sure, thanks, Jack. There are 4 major factors when you're looking at interest rate hedging and accounting, and you always want to start with the economics, including what your risk is and what it is that you're actually trying to protect. Then you want to look at different ways to protect that risk and the effectiveness of that protection. Today we're going to focus in on the risk of rising rates, specifically honing in on protecting variable rate debt with a floor from the risk of rising interest rates using an interest rate swap. We'll talk about the risks and rewards of including a matching floor and how that impacts the effectiveness of the derivative. All of these factors feed into the interest rate risk hedge accounting decisions and processes. We're going to start with the debt itself because it's the underlying risk and what you all have in common. So if you change the slide, variable or floating rate debt is a key component of many corporate capital structures. In the US, most of the variable rate debt that we see, whether it's a term loan or a revolver, has a floor of 0%. In the last month or so, our clients that have been in the midst of refinancing, and we've had several, have seen a push for higher floors up to like 0.75% or even higher. In Europe and the UK, we've seen both 0% floors and even negative percent floors that match the spread over floating. Floors on variable rate debt protect the lender by ensuring that they will not have to pay the borrower. In the case of a 0% floor, it ensures that the lender will receive at least the fixed spread. Alternatively, lenders can protect themselves by increasing the fixed spread that corporates pay over the floating rate. So keep in mind when you're negotiating your debt that spreads are constant, typically within a range depending on your financial ratios, but they're constant. And a floor only impacts interest expense when the floating rate is below the floor. As you can see from the pictures on the screen, rates dropped significantly in the US between December and the beginning of April. In fact, they plummeted just in time for quarter end. This has had a huge impact on borrowing and corporate hedge programs. In both Europe and the UK, rates dropped in February, and then they came up a bit in early April. So as you know, negative rates are not new in Europe. They've been hanging around now for years. Up until recently, there was little to no talk of negative rates in the US, and many continued to think that negative rates are impossible here. Well, clearly, US negative rates are not impossible. We've seen treasuries dip below 0 and LIBOR is skirting 0. What this means for hedging and hedge accounting is that the impact of having a 0% floor on your borrowings has increased. So let's take a look at some numbers so you can get a good idea of the impact.
Before you go on, are there problems if you got a contract without a floor?
There can be, Jack, yes, because when rates get low, and we're going to see that in the next slide actually, but when rates get low, you can end up paying on your derivative, which we'll go over the structure of a little bit later, but you can end up paying on both sides of your derivative.
And that's not good.
No, that's not.
Okay, so if we go to the next slide.
So what I'm trying to show here is how dramatically floor values moved recently. So at the top is a 5-year 0% USD floor valued at inception in June of 2019. It was worth $158,000. Now that $158,000 is spread over the 5 years with most of the value in the last 2 years of the floor, when there's a higher chance that rates will actually dip below 0, and there's more time for it to do that. Now keep in mind that the market value of options, either floors or caps, is dependent not just on current interest rates, but also on volatility, which is the level of market movement. So in December, the middle one here, in December, roughly 6 months later, that same floor, which now has about 4.5 years left on it, is worth $97.7 thousand. So you can see it came down pretty significantly, and that's because rates were up They had actually increased, and the time to maturity has decreased, so less time for it to go negative. And then by the time you get to April, the beginning of April, that same floor, the value of it has skyrocketed to $385,000.
Why did it move so much between December and April?
That's a great question. And actually, to be honest, it moved that much really in like late March is where that big change happened. And it's due to, well, the large increase is due to the combination of an increase in market volatility as rates started to plummet and that large drop in rates. So now what you have is you have a very low interest rate environment where it's more likely that rates will go below zero, and you have a lot of market volatility, both of which feed into that large increase. So in hedge accounting, when you measure the changes in your debt due to the hedge risk, you must include the value of these floors, which as you can see has been very volatile over quarter end.
Okay, so if we go to the next slide where you're talking about protecting volatility.
Yes, exactly. So if you move on to the next one, when you hedge, you always need to start with understanding the corporate risk appetite. No matter if you're hedging your interest rate risk, foreign exchange risk, commodity risk, or really any risk, as the costs of the protection go down, the risks go up. When you're contemplating the structure of your derivative or your protection, there are really three balls that you need to juggle: economic risk, accounting risk, and cost. So economically, you have decisions to make on how much of the risk you want to offset. Many corporate clients protect a portion of their variable rate debt with derivatives to manage the fixed versus float structure of their balance sheet, taking into account not only their borrowings, but also their investments. So some clients want to protect all of the risk of rising rates on the portion of the principal that they're hedging, and other clients are comfortable taking on more risk by bifurcating the embedded floor from the protection. Now, from an accounting risk perspective, you need to consider how your derivative structure will impact your P&L as rates move up and down. You should look at this from two different perspectives. The first being effectiveness. Is the derivative effective, and is it expected to remain effective over time? And then second, what is the P&L impact if rates move up or down? Do you have 100% protection on the hedged principal amount of the borrowings, or only partial protection? Finally, you have to consider the cost of the derivative. The more complex the structure and the more customized the terms, the higher the cost will be. It's not uncommon for companies to enter into a derivative structure that closely, but not perfectly, matches the underlying hedged borrowings.
So what's the most common derivative structure that you've seen?
Well, Jack, if you'll flip to the next slide, I'll show you. It's really an interest rate swap. And an interest rate swap has two legs: a floating or variable rate leg and a fixed leg. When the company objective is to fix your interest expense, and pay fixed or receive floating swap is really a good match. If you look at the picture on the top left of the screen, you can see that the company in the circle pays 1 month LIBOR on the floating rate debt. On the interest rate swap, it will receive 1 month LIBOR and pay 1.25%. The 1 month LIBOR that the company receives from the interest rate swap cancels out or is paid to the lender, and the company is left paying 1.25% in this example. Now, obviously, I've ignored the fixed spread, but that's okay because that's fixed just like the 1.25%, as long as your financial ratios stay within the band set by your borrower. Now, the other key pieces of a swap are the notional amount and the time period or length. So you could have a $100 million swap for 5 years or a $10 million swap for 10 years. Those are set in the contract, and they're set at inception. So interest rate swaps are typically traded at zero cost. The fixed rate of the swap, the 1.25% in this example, is set to zero out all of the projected variable rate payments. So for example, a very simplified example, keep in mind, if you have a $10 million 1 year, 1 month LIBOR swap, and 1 month LIBOR is projected to be 1% for the first 6 months and 2% for the last 6 months. Now, obviously, that's not a real example, but if you had that, then the fixed rate would be 1.5%. It would be the average of the 1% for 6 months and the 2% for 6 months. And that's how those fixed rates are set. So when we talk about the cost of the derivative, it's not in cash paid up front, but it's in that fixed rate. The fixed rate is higher when rates are higher, the curve is steeper, your credit is worse, etc. The fixed rate is also higher if you put a floor on the variable side of the swap, limiting the fact that you will pay if rates go negative, or the amount that has to be paid on that floating leg. Now take a look at the picture on the bottom right, which shows the impact of a 0% floor and negative rates. When 1 month LIBOR is less than 0, the company, again ignoring the fixed credit spread, will pay nothing to the lenders, and conversely, the lenders will pay nothing to the company. Now on the swap, which in this example has no floor, the company will pay the fixed rate of 1 1/4 as we expect, but in addition, when rates are less than 0, they're going to end up paying 1 month LIBOR, that negative rate. So as you can see, when you don't mirror the floor that's embedded into your borrowings in your derivative and rates go negative, it will impact your interest expense line. You will pay more than the fixed rate, which puts your objective of fixing that portion of your interest expense in jeopardy.
You must have a 0% floor, surely, in that example, that last piece of your example.
Well, interestingly enough, not every company chooses to match the floor because, again, there's a cost to it. And this example actually holds if you have a floor of 0.75% or any other strike on the floor. Anytime that rates drop below the strike on the floor, you're going to have a mismatch if you haven't replicated that floor on the derivative. Yeah, so let's take a look at the next slide, and let's talk about that question in more depth. Why aren't companies matching those floors? Well, it's cost. The fixed rate of the swap increases when you add a floor. Now, depending on volatility and where rates are, including a floor can cost anywhere from a basis point or two to many basis points. Think back to the floor that we valued a few slides ago that increased from 98,000 to 385,000 in just a couple months. So let's take a look at what you can do now if you didn't match that floor. Because my bread and butter is hedge accounting, I tend to think of effectiveness first. Also, from a high-level point of view, hedging is supposed to mitigate risk. So in the case of rates dropping and a company with variable rate debt, obviously, economically, the company is actually better off without hedge. However, many companies are comfortable giving up the potential of less interest expense if rates fall in return for known interest expense, which really is protecting them from rising rates as well. Now, when you don't replicate the floor and rates plummet, you've actually created some P&L volatility in that your interest expense is no longer fixed, but is subject to a LIBOR component again. As we saw earlier, the impact of the floor goes up significantly as rates fall, which means that swaps without a floor, as compared to the debt with a floor, will not have similar changes in fair values. The offset is less effective. So as of quarter end, many of our 0% floored borrowers with unfloored swaps, they've continued to have highly effective hedges, but this is dependent on the rate environment when the derivatives were actually traded and how long these low rates last. Now in the US, the use of qualitative testing for derivatives where the critical terms do not match is fairly new. Many of these structures continue to be tested quantitatively using regressions, but not all of them. For those employing a qualitative method, consideration should be given to revisiting your initial quantitative test. Now for those clients with floors above 0% hedged with swaps without a floor, we've seen effectiveness fail this quarter. If rates continue to stay very low, we are at risk of more hedge accounting failures.
Is there anything that can be done with these failures? Because it seems horrendous.
It is. And yes, of course, there is something that can be done. So if you flip to the next slide, what we're recommending is that after you refresh your quantitative test, take a look at where the issue lies. Most likely, it's in the slope of the best fit line. The slope of the line shows how for every unit change in the derivative, X units of change are expected in the hedged item. Now, I don't want to go down the rabbit hole of statistical analysis. Let's just suffice it to say that slopes can be changed by rebalancing. In the US, you will need to do a redesignation and change the principal amount hedged. Under IFRS, you can typically rebalance your relationship as needed, subject to some restrictions. These strategies will help protect your accounting, but really do nothing for the economics. For the economics, you can add protection by purchasing a floor to add to your swap. In order to mitigate the cost of the protection, We've seen some companies that are choosing a shorter dated floor than the swap so that they're protected only for a few years rather than over the entire hedge period. So that kind of depends on where you think rates are going and, again, bringing cost into this. So as you're working your way through the repercussions of low rates, don't forget to negotiate. As we've seen, swaps with floors cost more. Be aware and educate yourself on what to expect before you start trading. Negotiate with your counterparties to get the best possible pricing. You can also negotiate the value of the floor on new or refinanced debt. When you have a better understanding of the value of the floor that the bank is requiring, it puts you in a much better position to actually negotiate your terms.
Is that negotiation the key in all of this? It's getting the balance of the different combinations of floors, interest rates, swaps, the whole piece.
It really is, because these derivatives that we're talking about are over-the-counter derivatives, so you can customize them. But as I had mentioned earlier, the more customization you put in, the higher the cost. So it's looking at your risk appetite and balancing the cost of 100% perfect with good enough, and then negotiating with your counterparties to get you the best possible pricing that you can for these derivatives.
Horrendously complex problem. So you've talked enormously about a whole range of different aspects of floors and so on. If you bring it all together, what are your key takeaways? And I'll move to the next slide.
Well, hedge programs are not set it and forget it. They need to be monitored, especially in times of high market volatility. You want to weigh the risks versus the cost of protection and revisit that as needed. Don't forget to monitor your effectiveness assumptions, particularly if you're using qualitative assessments and there's a big market movement. You can add a floor for short-term protection. Don't forget that if that's needed. And then finally, I recommend annual hedge checkups. I think they're essential, just like you should have a medical checkup every year.
But how do you know when to do this?
Well, the key triggers for revisiting your hedge program are really market movements, as we've discussed today, but then also whenever your risk appetite changes. So you may have...
Does that mean a new CFO or whatever?
Exactly. You could have a change in management, or there could be other internal changes, different strategies, different things going on internally. So whenever that's happening, you want to look at your hedge strategies and start reviewing them. You should also review your hedge strategies whenever you're going out to the market to secure new debt or extend your current debt. Maybe you need to extend your hedge strategy. Maybe you need to go out longer, or maybe you need to add a floor because your floor is changing, or you need to change your floor. A few years ago, I actually had companies that were able to negotiate lower floors, and they had matched the floors on their derivatives. So they actually monetized those floors and got out of them and then redesignated their derivatives.
If you bring all this together, what would be your final comment about this? What's the thing that the corporate treasurer should go away with?
Well, what I'd like you all to remember is that hedge programs are not set it and forget it. You want to be sure to keep your fingers on the pulse so that you know when to revisit strategies and assumptions, not just so that your hedge accounting doesn't get messed up, but to keep an eye on those economics as well.
Thank you. And obviously the final question from me is going to be, what is the impact of COVID-19 crisis on hedging? Because this low interest rate environment is going to go on for quite a while.
So that's an interesting question. On the stuff that we've been talking about today, where we've seen some impacts is on the debt side, and if you're in the middle of renegotiating your debt. There's a lot of uncertainty in the market. Part of that's from the interest rates, but a lot of that is, feeding from COVID-19. So you might see that your floor percentages are going up. Now, we've been talking about cash flow hedging. On the fair value side of hedging, there's been quite a few impacts because borrowers are being given holidays on their interest expense, on their debt payments. Things are getting pushed out, and that has quite a big impact on the fair value side of things.
Ruth, that was really interesting, really important. Thank you.
Thank you.